If you're joining us today, chances are you're looking for trusted strategic guidance on how to navigate the increasingly volatile financial landscape, especially as you prepare for or enjoy your retirement. And you are in the right place. Our host this morning is someone who spent more than 35 years helping families protect and grow their wealth with smart, tax savvy planning. James Lange is a CPA attorney and a nationally recognized expert on Roth IRA conversions, retirement plan distributions, and holistic tax and estate planning strategies. A prolific writer, Jim's retirement planning techniques have been featured in the Wall Street Journal 36 times, and he's authored 10 best-selling financial planning books, including Retire Secure, The Roth Revolution, and Retire Secure for TIAA participants and professors. But what truly sets Jim apart is his ability to take complex tax law and turn it into clear, actionable strategies. He's been ahead of the curve for decades, from publishing the first peer-reviewed article on Roth IRAs in 1998 to predicting the end of the stretch IRA years before Congress passed the Secure Act. Through his interrelated firms, including a CPA firm that prepares more than 750 tax returns annually, and a registered investment advisory firm that helps manage and plan for nearly $1 billion in assets under management. Jim and our team have helped hundreds of families build personalized financial plans. And Jim is no stranger to interviewing financial luminaries. For many years, he hosted a weekly radio show and spoke with an array of experts, including Ed Slott, Roger Ibbotson, and even Vanguard founder John Bogle himself. And today, he'll be speaking with one of the most influential voices in the world of investing to help answer a critical question. In a time of market stress, rising deficits, and political instability, what should smart retirees actually do? Please join me in welcoming Jim Lange. And now it's my tremendous privilege to welcome Dr. Burton Malkiel to today's first session. Dr. Malkiel is one of the most influential voices in the world of investing and economics. He's the author of The Investing Classic, A Random Walk Down Wall Street, which marked its 50th anniversary with a new edition in 2023. Widely described as required reading for anyone serious about long-term investing, it helped popularize the use of low-cost index funds among everyday investors. Over the last 5+ decades, Dr. Malkiel's research and writing have fundamentally reshaped how professionals and individual investors alike think about markets, diversification, and investor behavior. He has served on the President's Council of Economic Advisors as Dean of Yale School of Management, and he's held senior roles at leading financial institutions, including Vanguard and Wealthfront. And of course, he's Professor Emeritus of Economics at the University of Princeton. You may have also recall that Jim interviewed Dr. Malkiel early in 2023 in a wide-ranging 3-part video series marking the 50th anniversary of A Random Walk Down Wall Street. Though that interview was reflective, those conversations were far more than a mere retrospective. They highlighted Dr. Malkiel's ability to apply his foundational principles, market efficiency, diversification, and discipline, to the realities of a rapidly shifting economic landscape. From inflation and tech sector volatility to international diversification and behavioral pitfalls, he offered pragmatic guidance informed by decades of empirical research. That clarity and relevance continue today. In a recent New York Times guest essay titled "The Stock Market is Getting Crazy, Here's What You Should Do," Dr. Malkiel addressed many of the same challenges we're all thinking about: market volatility, trade tensions, inflated valuation, and fiscal imbalances, while reminding readers to stay focused on the fundamentals of long-term investing. So we couldn't think of a better guest to help us answer this difficult but timely question. In a world of policy shocks, economic strain, and political turbulence, does the classic wisdom of long-term investing still apply, or are we in a new era that demands a new playbook? Dr. Malkiel, thank you so much for joining us, and I'll turn things over to you, Jim.
Bert's 13 editions of A Random Walk Down Wall Street sold, and there's conflicting numbers, but somewhere between 1.5 and 2 million copies. Usually a successful financial book sells about 10,000 copies. So it's just a huge force. It is universally regarded as one of the most influential and enduring financial books ever written. And if you don't have the silver anniversary edition, please do yourself and your family a favor and buy it today. You can get it on Amazon or at your favorite bookseller. He's a generous man with both his time. He's helped a limited number of other financial writers, including me, by writing both generous testimonials, and he actually wrote the foreword for two of my books, which I greatly appreciate. But Bert's books, more than any book or paper ever written, popularized the efficient market hypothesis, one of the foundations of successful investing that is just as important as it was today, as it was 50 years ago, as it is today. Back then, nobody ever heard of index investing or markets are efficient, but Bert actually was the force of making this more or less an everyday concept. And then Jack Bogle, the founder and former CEO of Vanguard, together they, I believe, changed the world. Now, to be fair, Gene Fama and Ken French deserve some credit too. And by the way, I should mention that except for Jack Bogle, who did pass, these great influencers are alive and with us today, and they are actively writing in their 70s, 80s, and 90s. So why don't we get right into it? And so Bert, you have this efficient market idea. What do you mean when you say markets are efficient?
Basically, Jim, what the efficient market idea is a statement that information gets reflected in stock market prices without delay. To give you an example, suppose we have a biotech company that just announces a very successful phase 3 study of a drug that promises to cure a particular kind of cancer. And the results are very favorable. And it looks like the results are so favorable that the drug will be approved, and that finally the sales of this drug should give this company a value in the market something like double what the market is today. The efficient market idea says that the price of the stock will double, but it won't double slowly over time. It'll double right away. In other words, if the price was 20 and it ought to be selling at 40, it isn't going to go to 40 a little bit at a time, because anybody who buys it below 40 is going to make a big gain. So the market will get to 40 right away. So that's the first idea of efficient markets, that information gets reflected right away. Now, it may be that in going to 40, the stock has overreacted. Maybe there'll be some side effects that while the drug could be approved, the FDA could insist that there be a black box warning about the side effects. Or perhaps the market underestimates this, that maybe it ought to triple, because the market for this drug, if successful, ought to be even greater than a doubling would indicate. So the market may not get it exactly right, but the point is the idea of this drug increasing the value of the stock will be reflected in the price right away. So that's the sort of first idea of efficient markets. Now, what it doesn't mean, and this is where a lot of people who say, oh my, Bert, the market's not efficient. The market goes crazy sometimes. So the second part of it is, it doesn't mean that the market always gets it right. In fact, I would say that the market always gets it wrong. No prices are exactly correct. The market always makes mistakes. But the problem is, while the price of a stock may be too high or too low, nobody knows for sure whether they are too high or too low. You know, maybe some people will say, gee, the price of this biotech only doubled. It ought to triple. I'm going to buy it and make more money. And maybe they will. Or maybe the stock doubles and somebody thinks, oh boy, the side effects are so terrible here that the FDA might not even improve the drug. And I'm going to sell it short and make some money. But nobody knows for sure. And this then leads to the second point of efficient markets, that while prices are never absolutely correct, no one knows for sure whether they're too low or too high. And therefore, there are no arbitrage opportunities. Now, when an economist talks about arbitrage opportunities, they're not being strict to the term arbitrage. What the term really means is that when the same commodity is selling at different prices in different markets, you buy and sell in the two markets to make a killing. For example, suppose the euro is selling for $1.17 in Europe, and the euro is selling for $1.16 in New York. Well, what you do is you buy euros in New York, you take them to Europe and sell them for $1.17, and you make money. That's what arbitrage actually means. It's used loosely in the finance literature to suggest that it's arbitrage if there's one drug company that's too expensive relative to another. We sell one and buy the other. We buy the cheaper one and sell the more expensive one. And an arbitrage opportunity, as it's used in finance, is an opportunity for some kind of either riskless gain or gain with almost no risk. And what efficient market says is, it's not that market prices are always right, but there are no opportunities for riskless gains. Maybe there's a meme stock that just went absolutely crazy, and maybe some hedge fund selling it short will make a killing when the bubble pops. But some other hedge fund will go bankrupt, as happened, in fact, with some of the meme stock crazes. And there was certainly no riskless arbitrage. So again, to summarize, information gets reflected quickly, and while prices are not absolutely correct, that's not what efficient markets mean. Well, while they're not correct, there are no arbitrage opportunities. There are no opportunities in the market to make riskless gains, to make gains higher than the market return without taking a lot more risk.
Well, so Bert, I mean, you're probably, if not the most credible person to listen to on finance in the world, certainly one of them. And let's say somebody says, okay, this guy really knows what he's been doing. He's at the top of his game for 50 years. And hopefully they do read your book, which, by the way, does a lot more than just talk about efficient markets. But let's even say that a reader agrees with your premise. What should they do differently than they might be doing, say, right now?
Look, the market has gone up for 100 years. Stocks in general, for the last 100 years, have produced rates of return of about 10% a year. So a lot of people, if they're in the market, whether they follow my advice or not, have made money. What my advice is because stocks have been such great investments, one ought to have some of one's assets in the stock market. And the way to do that is to buy an index fund. Now, what an index fund is simply a fund that holds all the stocks in the market. And the advice that I have given, and it really comes out of the idea that markets are reasonably efficient, is that to the extent that you hold the stocks, you're better off holding them as index funds or exchange traded funds that are indexed than trying to pick winners and losers. And the evidence is so clear that over decade after decade, active investors, those who try to pick the best stocks, do not do better than the index. In fact, over 10 and 20-year periods, over 90% of professional active investors do worse than a low-cost index fund. So I'm not saying that there's nobody who can beat the market, but if you try to beat the market, you're far more likely to be wrong than right. You could be in the 10%. You could find, boy, I'm a Warren Buffett, and there'll be Warren Buffetts in the future, but you're much more likely to be in the 90% who do worse. And therefore, the advice in edition after edition of my book, and the evidence has gotten clearer and clearer, that index fund investing is not average investing. The index investor gets above average returns. And that, of course, is the lesson. And one of the things that I am proudest of in the book is that when I first wrote the book, there were no index funds. And I know in the first edition of the book, I said, when I say you ought to buy an index fund, people say you can't buy the index. And I said we ought to have an index fund. It wasn't until 3 years later when Jack Bogle introduced the first index fund that people could do it. And now, of investment funds that are in your beautiful Roth IRAs, now the index funds are more than half of the investments in retirement funds. They've grown that much, and I am delighted to have been part of what is truly called the index revolution.
Well, I don't think it's an overstatement to say that you did change the world. But with all your accolades, I think are you telling our audience that, that they shouldn't either try to beat the index on their own or even follow financial giants, including one unnamed giant who just spent $3 billion on a new building in New York City? So what is so great about an index fund?
Yeah, that is exactly what I'm saying. And let me give you an example with one of those giants, Warren Buffett, who probably is the giant among giants. He's the one who's got probably the best long run record that we've seen in the investment world. Well, let me tell you that even Warren Buffett now recognizes the value of index funds. And as he's written his will, he has suggested that his heirs invest the proceeds in index funds. And let me tell you something about his investment vehicle was called Berkshire Hathaway. And over the long period, he's been in that 10%. In fact, he's probably been at the top of that 10% that outperformed. But even Warren Buffett over the last decade has underperformed an index fund. Warren Buffett made this famous bet with a hedge fund manager, and the bet was it was $1 million bet. The proceeds would go to charity, and he said, "My index fund," and he just picked an index fund, "will beat 5 of the best hedge funds that you can find over the next 5 years." Well, the results were that his index fund did beat the hedge funds, and he or his charity actually won the bet. Well, what people don't realize is during that 5-year period, the index fund also beat Berkshire Hathaway. So the problem is there's no consistency to outperformance.
Well, let's even say that somebody says, okay, well, index or a passive type investment, but hey, I see what's going on in the market, and right now is going to be a bad time to buy. But I think, and I've read all these articles, that it's going to be a great time to buy in a month from now or 2 months from now. Or you see it, in the press all the time. This guy predicted the 5 biggest downturns in the last 20 years, and he's predicting another one to come in 2 months. Can we do index funds, but then also try to time the market to, in effect, buy low and sell high?
Well, Jim, that actually brings up another aspect of the efficient market idea. That not only is the information about individual stocks impounded into the prices, but to the extent that we know that bad things are going to happen or good things are going to happen, the market already reflects that. And therefore, any attempt to time the market is not going to work. And this leads to the idea that in an efficient market, not only should you not buy individual stocks, but you should not try to time the market, because you will always get it wrong. And the market prices from day to day and year to year really almost, the market will change when there is news. But true news, by definition, is random. In other words, if somebody says, here's a headline, retailers are now stocking up for the Christmas season, that's not news. I could have written that 6 months ago, that they would be doing that at this time. If there is a nuclear holocaust and China aims nukes at Taiwan, that would be news, but that's unpredictable. And the idea of the market prices being unpredictable is that they will move on news, but true news is random. And that gets to the title of my book, A Random Walk, because stock prices move in what is essentially a more random fashion. Now, I will say this. There is one idea about market prices that is inconsistent with the random walk idea. And it's one that I've admitted throughout the editions of my book. There is a little bit of momentum in the market. Markets are not completely random. If the market went up the last few weeks, it's a little more likely to go up than down in the next day or the next week. Having said that, though, those regularities are so small, and people who act on momentum suffer from what are called momentum crashes. In other words, something is going up and up and up and up. This meme stock is going up and up and up. NVIDIA is going up and up and up, and then all of a sudden it will go down. There is a bit of momentum, but it is so small that you ought to ignore it because, again, we've got an enormous amount of evidence that people who try to time the market, whether they're amateurs or professionals, are much more likely to get it wrong than get it right. We just did a study at Wealthfront that indicated that we've had economists who have published studies of people who have trading accounts at some of the leading brokerage firms in the country. And the evidence is very clear that when you try to time the market, despite the fact that there's a bit of momentum, people are more likely to get it wrong than get it right. And this is particularly true if they use their emotions to buy and sell, because people tend to buy when everyone is optimistic, and people tend to sell when people are pessimistic. And it's often that leads them to do exactly the wrong thing, that they will be buying when market prices are at a high and selling when they're at a low. And my very strong advice is don't try to time the market. You'll never get it right. The market acts more like a random walk than anything else. Don't try to time the market. You will do worse by doing that rather than helping yourself.
Can we talk about something that you write about and often speak about? And we spoke for a minute or two about it before we started, and that is asset allocation. And I assume that you mentioned maybe one index fund, but let's assume for discussion's sake that most of our audience today is probably in the 60 to 90-year-old age category. And of course, everyone, every financial situation is different. But can you provide some asset allocation for an older audience, and maybe even more specifically, an audience that is no longer working? So they're not bringing in money from wages or self-employment.
Sure. And this actually leads to another fundamental investment recommendation, and that is diversification. That while I do want you in your stock market investments to buy a total stock market index fund, because that's the most diversified, I also want you to diversify among asset classes. And by asset classes, I mean particularly that you ought to include in your portfolio some assets that do not fluctuate as much as common stocks do. The reason common stocks have given you a 10% rate of return is they are risky. The stock market has gone down 40% on many occasions over the last 100 years. If you are living on your retirement savings, I don't want you all on the stock market because, if you're in your 80s and you're counting on those stocks for your living expenses, and the stock market goes down 40%, and it'll happen again. I don't know when, but it will happen again. There are plenty of huge risks out there. You need some ballast. You need some stability. And I want you to have some safe income producing bonds in your portfolio. And now let me get to your asset allocation question. If you were in your 20s starting off, I would say you can ride out those ups and downs, and you ought to have pretty much an all equity portfolio. But if you're in your 70s and 80s, I want you to have a good proportion of your assets in safe income producing bonds. And if you're particularly wealthy, so you're in a high tax bracket, I want you to have tax exempt bonds, which are provide some very good rates of return. You can get a AA long-term tax exempt bond that yields close to 5% today. So I want plenty of that in your portfolio. How much? Well, that depends. If you have no heirs and you need all that money to basically keep the family afloat in retirement, and this is all you've got, then the proportion that would be in fixed income could be actually quite high. 50%, let's say. I still want you to have some common stocks because one of the risks out there, and I think it's a real risk, is a risk of inflation. And I worry about that because we've got a big budget deficit. We've got tariffs. We've got a lot of things. We're now going to stop immigration. I think there are going to be a lot of inflationary tendencies, and common stocks are a good hedge against inflation. Over the long run, that's one of the reasons why they've given you the 10% rate of return. So I don't want you to have zero stocks, but I want you to have a big bond allocation. If, in fact, you've got enough money that you're not worried about your nest egg to live on, and you're investing for your children and grandchildren, then I want you to have less in bonds. You still need some bonds because you'll need some money for your living expenses, but then it could be 25% or even 20%. So I can't give you one figure, and it'll depend on how much money you've got. It'll depend upon your risk aversion. But in general, I want you to be diversified with different asset classes. And let's go back to the market timing idea. The one thing I do want people to do today, where the market's been going crazy on the upside, we're in quite a boom now. People are very optimistic. Maybe they're over optimistic. I want you to make sure that you rebalance. Example, suppose you're somebody who is living on your retirement funds, you don't have any heirs, you are 50-50 stocks and bonds. and you look at your Roth IRA and you say, "Oh my God, the stock market's gone up. So I'm now 60% in stocks and only 40% in bonds. I want you to rebalance." This is the thing that you should do. Sell 10% of your stocks, put them in bonds to go back to the asset allocation that's appropriate for your risk level and your income needs. So definitely rebalance and set a diversified asset allocation, because clearly retired people should not have 100% 100% stock portfolio. Let me just say one other thing. I know you have been instrumental in getting people to move their IRAs into Roths. Let's say that you've got a traditional IRA, and you're now in the situation where you have RMDs, required minimum distributions. I'm in that situation now with the retirement plan that my university has given me. The RMD that I'm going to have to take for 2026 should not be in the stock market. It should be in 1-year Treasury securities, where I know there's not going to be the fluctuations, because I can't count on 2026 making sure that the stock market is going to be in the same place it is today. So again, in choosing the asset allocation, think also about the particular expenses you're going to have, including your required minimum distributions, and make sure that the things like the RMDs, where you know what the expenditure is going to be 6 months from now, a year from now, make sure that those are in assets that where the values will not change from period to period.
Well, now you're bringing up a whole different or associated world, which might be referred to as asset location. So, for example, in the Roth IRA world, and I'm intimately involved in writing and overseeing a lot of Roth IRAs, and I've been following Roth IRAs even before they were law in 1998. And to my knowledge, with relatively few exceptions, few people, including my own family, will ever spend their Roth IRA. My wife would eat rice and beans before she ever spends a nickel of our Roth IRA. Are you now also saying that let's say, for example, if you know that you're that kind of person, that maybe you would have a different time horizon for your Roth than the money that you're going to need to live on, and hence you would have a different asset allocation within your Roth that might have a longer time horizon than other money that you are planning on taking out and spending sooner. Is that
Jim, you're absolutely right. You're absolutely right. And I think the way that you have put it is particularly good. It's the time horizon that is so important. And from what you have described is that the time horizon for your Roth may well be not your time horizon, but the time horizon of your children and your grandchildren. And therefore, the right asset allocation is much more heavily weighted to common stocks. Because if we live in a world, and I'm very loath to make predictions, but even if let's say we're so optimistic that we're going to get down to 2% inflation, which is the target of our central bank. Even if we have just 2% inflation, the asset class that will protect us from 2% inflation is common stocks. It's not bonds. And therefore, the asset allocation for that IRA is definitely going to include more equities, more common stocks.
All right, so if we could maybe switch gears a little bit, and Erica mentioned your op-ed in the New York Times, where you warn that jubilant investors are pushing the market to historic heights. And then you talk about some of the things that you're not a great fan of that is going on in the current administration. You talk about tariffs and things that tend to not be, let's call it, free market. How do you reconcile your advice of staying in the market with all the things that are, and we'll get to a bunch of the individual things, but maybe start off with a framework, because the way the article read was, well, this is wrong, this is wrong, this is wrong, this is wrong, but stay in the market anyway. Is that a fair characterization?
Sure. Okay, Jim. Let me talk about that. You've got exactly what I said in that piece. Let me just say, since we're talking a little bit about politics, I am a lifelong Republican. You had mentioned in the introduction that I had spent time on the President's Council of Economic Advisors. This was in a Republican administration. So I consider myself politically really quite conservative. And having said that, I am very upset about a lot of things that this administration is doing, in that I think many cases they don't believe in markets. And I think that a world trading system makes all of us richer, not poorer. And I think tariffs are going to make us a lot poorer. If we have a tariff on, for example, Canadian aluminum, where Canada has a big comparative advantage in producing aluminum, and instead we're going to try to do it ourselves, which I'm not even sure we could do, because I don't think we've got the power to do it. And Canadian aluminum manufacturing is done almost exclusively with hydropower, which Canada is blessed with. We're going to put tariffs on aluminum. We're going to be worse off. Canada's going to be worse off. We're going to be worse off. I think it's a terrible thing. I think we're a nation of immigrants. I wouldn't be here if my grandparents hadn't come here as immigrants. I don't like, I think we certainly should have legal immigration, but I don't like the idea of rounding up as many immigrants as we can find, and making it harder to get H-1B visas. I think just a lot of this is wrong. I don't think the government ought to take stakes in companies. I think that's not capitalism as I understand it. That's, I think, the wrong way to do it. And yes, you're absolutely right. I think there are unusual risks today, and they scare me.
Do they
Why do I
you?
say stay in the market? Well, I'll give you two reasons. First of all, I think a lot of these things are quite inflationary. I think the tariffs will be inflationary. I think that cutting the labor force by making immigration almost impossible now is going to be inflationary. And if we're going to be in an inflationary environment, you don't want to sell all your common stocks, because that's the best way that you will be able to hedge. Because remember that stocks represent ownership of factories, of real assets that will appreciate with inflation. So the first reason to stay involved in the stock market is that some of the bad things that are going to happen if we persist in what we're doing will not hurt common stocks. They'll actually help common stocks. Secondly, one of the things we ought to know about investing and about our political system is we have gone through waves of tariffs, of we don't want immigration, we don't want civil liberties, and it's not forever. And one of the things is, and I did this in the New York Times article that you mentioned, one of the quotes, he didn't actually say it, but falsely attributed to Winston Churchill, is that, you know, what happens in the United States, they sometimes do a lot of crazy things, but eventually they get things right. Donald Trump is not forever. And we are not going to, this doesn't mean that this is the permanent regime in the United States. And, you know, as they say in the Bible, this too will pass. I'm not willing to say that we're going to continue with this craziness forever. So the fact that we're doing some bad things now doesn't mean that we're going to be doing bad things forever. And the third point about staying in is, if you try to time it, if you try to say, I mean, look at the poor people who, what, the market went down 10% right after, quote, Liberation Day. And everyone was throwing up their hands saying, oh my God, this is the end of the world. Those people missed a huge increase in stock prices. When you try to time the market, you're almost invariably going to get it wrong. And those who did this after Liberation Day are kicking themselves. Don't try to do it. Please, you, as much as it needs fortitude to stay the course, I am absolutely convinced that people who stay the course will turn out with better results than people who try to time the market. So yes, I'm worried, but I say that doesn't mean I'm going to sell all my stocks, because this will not necessarily be forever. And to the extent that there are bad results, they're likely to be inflationary. And in an era of inflation, and unfortunately, I think the way we're going to get rid of our budget deficit is the way we did after World War II. We inflated it away. And that's what I think is going to happen. I don't like our budget deficit, but I don't think we're going to solve this by good fiscal policy. I think we're going to solve it with inflation. And if we are going to be living in even a 2% inflation world, you still need common stocks in your portfolio.
Well, let's go back to something you said, quoting the Bible, this too shall pass. Let's say that I'm not so confident that a lot of things are going to, quote, go back to normal. So I'll just take one area where I have a little expertise, and that is dealing with the IRS. And according to the Treasury Inspector General for the Tax Administration, in just the first 3 months of 2025, the IRS lost 3,600 revenue agents. That's about 31% of their staff. Now, trained auditors bring in roughly 8 times their own salary, and you're just slashing the number of trained auditors out there. Now, the world says, oh, gee, if if all these trained auditors are slashed, I have a lower chance of being audited. Maybe I can take a few more risks than I would have otherwise. In addition, let's even say the next administration says, hey, we have to beef up the IRS. Well, now you've lost these trained, professionals that have been doing this for years and years, and you have to go out into the market. And I will tell you, because I try to hire senior CPAs, it's very hard to find a qualified, experienced CPA. They're gonna have to hire probably younger ones if they can get them, spend years training them before they can get break even. So I'm not so confident that things are gonna, let's say, turn around quickly. And of course, that's the way the United States gets money, although maybe now with tariffs it's a little different. Do you worry about something like that, that maybe things are going to be broken or damaged so badly that it's not going to be, oh, new administration, new everything, that we're going to be behind the 8 ball in a lot of areas? The IRS being,
Couldn't agree with you more, Jim. I think that's absolutely right. I think we will collect less revenue. I think this is going to make the deficit even worse. And I also agree with you that solving it won't be done with another administration. It may be a decade before, if you had the guts to go back to normal, that we would. So let me take your hypothesis and say I'm absolutely agree with you. What does that mean? It means a bigger budget deficit, and it means more inflation. It means a looser fiscal policy, and it will happen for at least another decade. Does that mean I shouldn't have any common stocks? No. It means we're much more likely to have excessive fiscal stimulus and more inflation than we otherwise would. So, agreeing with you and agreeing that that is a problem, and agreeing with you that if this passes, it may not pass for a decade or more. Does that worry me? Absolutely. But again, it doesn't mean to me that I therefore want to sell my entire stock portfolio.
and would that also apply to other things that you might not like what is going on right now? So, for example, and we've never talked about it, but let's say that you disagree with some of the health policies, that you do believe in vaccines and certain other preventative medicines that are being discouraged, and maybe even potentially false information is being given to almost predict additional disease down the road. And it's going to cost the medical system even more money to treat people because we're not being smart. And you would say, and I don't know if you agree with that or not, but let's say you did, you're saying that that's still not a good reason to, let's say, bail and just hunker down and try to get some more conservative investments.
Well, let me give you a sort of historical example. We've had Galileo uh, argue that, in fact, the Earth revolved around the sun the sun didn't revolve around the earth. And he was then imprisoned and spent the rest of his life in prison. And finally, people like Isaac Newton came along and said, Galileo was absolutely right. And we finally got the right answer. I don't think science is ever going to die. We might have some crazy things that happen in the interim, but science will not die. And you can shake your head about some things that are happening now, but in the long run, I think science and learning from a standpoint of a university, I'm also worried about my university has just been hit with an 8% endowment tax on its income. And that's going to hurt our scientific research. It's going to hurt our ability to give student aid. So, a lot of things that I am very worried about, as you are. But again, I don't think it's forever. And eventually, science will win out, in my view. Now, you may think I'm being a Pollyannish. It may take a long, long time, and I'm certainly quite worried in the short run. But again, I don't think you will, however pessimistic you are. I think selling out your equities is not the right thing to do. And I think in the long run, people will be very happy that they stayed the course.
Well, you've certainly been through an awful lot of ups and downs and have seen a lot of bad things going on. And, again, the people that did stay in stocks were right. Does it bother you, let's say, the increase of the expanding use of executive power in fiscal policy? So where you have President Trump trying to control things that presidents didn't typically control or attempt to control, and both the, let's say, fiscal policy and, for that matter, the judicial power concentration. And are you saying, well, this might be real bad, but just hang in there?
Let me add something which is, I think, a more problematic threat over the near term, and that is the president's view of wanting to control the Federal Reserve and put his own people in there and fire people who are sitting on the board of governors. And it's very clear exactly what he wants to do. He wants the Federal Reserve to push down short-term interest rates by 300 basis points or 3 percentage points in a period where inflation is not running at the Federal Reserve's 2% view of what's right, but rather at 3%. I think this is likely to be over the next few years, certainly putting added inflationary pressures. So again, yeah, I'm worried about that, but the economic fallout from that is likely to be inflation. And given that scenario for the economy, I don't want to sell all my common stocks. I do worry about the judiciary. I do worry about we've just had all over the country no kings rallies all over the country, and I understand exactly what motivates that, but I've got more feeling of hope for this is a country that has gone through a lot of very, very difficult things like a civil war, a horrible depression where 25% of the population was out of work, and where people were talking about a revolution was right around the corner. This has been a pretty strong country, and with a pretty strong record of democracy. And I am not willing to bet against the United States of America. Maybe that's too hopeful, but that's my strong feeling. And when at one point, when someone was telling me that I've got to sell all my common stocks because we're in the center of the Cold War, that we will not be able to avoid a nuclear holocaust. There are going to be hydrogen bombs going back and forth over the Atlantic that are going to hit all of our major cities. I've got to sell all my stocks. And I say to them, let's assume that that happens and we have this nuclear holocaust. The fact that your stocks went down will be the least of your worries.
No, the other thing that you said earlier, and I don't know if people picked up on it, but you said when you're buying a common stock, it's not just a number. This is a real business.
Exactly.
And the owners and the directors and the employees of this business wake up every day and say, how can I make some money? So maybe if there is a nuclear holocaust, maybe all of a sudden there'll be new markets in things of how to sell people goods and services that have, well, obviously survived, but are in a different situation. Well, you also mentioned the No Kings protest, and certainly, and I don't know what percentage of our audience are Democrats or Republicans or um, uh, somebody like you, a lifelong Republican that might not like what is going on. But let's say that you really don't like what's going on, and you don't just have, well, minor disagreement on whether tariffs are appropriate, but you just think President Trump is out to lunch. He should not be there. He isn't competent. He's not competent to run the economy. He's not competent to run the military. And they're not only afraid of what he has already done, both in terms of what he has done that has already had an impact, things he's done that we haven't seen the full impact, but things he will do. So let's say that you have this, let's call it, most of our clients, and it sounds like you too, are fiscally conservative. Your advice is still just hang in there, stay in the market, despite your feelings, and I mean, I have quite a few people, particularly in the academic community, when I don't know, maybe 80 or 90% are Democrats. They have enormous fears, but you would still tell these folks, hey, just stay in the market.
Yep, I would, because I am convinced that this is not forever. I think that Trump is not forever. And I have enormous faith in the strength of our democracy and the likelihood that our population will not make this a permanent factor in our economic life. So, yeah, I definitely think this too will pass, and that trying to get this right by trying to time the market will lead you to much worse outcomes. And the biggest mistake that investors can make is when they're pessimistic, even though there's lots of reason for pessimism. The biggest mistakes they've ever made were selling out when everything looked the darkest. And while they do look dark now, I have a lot of faith in the United States of America. And let me say something else. The other part of it would be a lot of people are worried about holding their assets in dollars. That what he's likely to do, if I'm right, is debase the dollar. And I think there is some real risk of that. I think that one thing that one could very well do, and let's go back to the point we made about diversification. I would like to see us not only in index funds that had all the United States stocks, but if one's portfolio is large enough, I would like to have my common stock portfolio also include stocks from international markets. And that would be another way of diversifying and limiting one's risk of one's portfolio.
Do we risk, though, that we are in an era where, for example, obviously a lot of people are worried about the dollar and gold is at an all-time high. So that would be one way of, quote, having a safer portfolio. And now if you were to buy gold at its high point, you could get clobbered later on. So do we have a worry that because of, let's call it, the irrational exuberance of certain things, that we could get into things that might seem attractive or more attractive, but end up getting hurt?
Absolutely. First of all, common stocks have proved to be a better inflation hedge over history than gold. So I'm not a gold bug. I understand why people have used gold as an inflation hedge, and it is, but I'd rather be in common stocks than gold because common stocks represent real assets, real businesses, real factories, and they will be a better inflation hedge in the future, I believe, than gold will be. And with respect to irrational exuberance, which you bring up, I think people should be reminded of the fact that the last big bubble that we had, well, the last one was a housing bubble. The bubble before the housing bubble was the internet bubble in the late 1990s. And many of the investors will remember that the stock market did decline by just about 50% in the early 2000s. And they will also remember that the person who first made us aware that we were really having enormous risk because we were in a bubble was Alan Greenspan, the head of the Federal Reserve. And that term that you just used, irrational exuberance, was a term used by Alan Greenspan to describe the stock market and the worries about the stock market. So you can then say, well, gee whiz, maybe what we should have done was listen to Alan Greenspan when he coined the term irrational exuberance. And there's possibly some irrational exuberance now, maybe a lot of irrational exuberance. So that's a good reason to sell, because after all, afterwards, the market went down 50%. What people may not remember is that Alan Greenspan made that speech in 1996. The market peaked in March of 2000. The market went way up. If you bought instead of sold the day after Alan Greenspan's irrational exuberance speech, you would have done extremely well. And in fact, if you had bought and held on till today, you would have had even a higher than 10% rate of return. Don't try to time the market. Even if you absolutely believe we were in an irrational exuberance era, if you believe that the hype on AI is overhyped, maybe it is, don't try to time the market. You will just get hurt.
Well, bringing up AI is an interesting segue to, let's call it the unknown. But if we listen to some of the gurus and the experts, and very frankly, they're saying business is going to be completely different. Things are going to be much different. The labor force is going to be different. There's going to be certain sectors that are going to do better, certain sectors that are going to do worse. Does this scare you, or do you see this as an opportunity for to do even better? Or is this the kind of thing that and I take it that what you're saying is the average guy or even the so-called gurus can't really guess better than anyone else what's going to happen. So just kind of stay the course.
Well, obviously, you kind of answered the question. You know, my feeling would be to stay the course, but AI, I think, will be very important. I think, like all other technological changes, I think the adoption will be probably slower than a lot of people think, but will be extremely important and will be part of a long run of technological improvements. That's one of the reasons why the economy grows. We've just had, in my own field of economics, the Nobel Prize given to 3 economists who have studied the important role of technological change in making our economy grow. AI is a part of it. I think the internet was a part of it. The Industrial Revolution was a part of it. The electrification, Thomas Edison was a part of it. There's a long string of it. I think it will continue. And in the long run, this will make us a stronger country, not a weaker one. But will it be hyped? It's been hyped. All technological change in history has been hyped. When the railroads came in, this was going to change the United States and make us a different country. And railroad stocks then went to unsustainable heights and then crashed. We've had the internet crash. We'll undoubtedly have an AI crash at some point as people continue to overhype it. But again, the people who hung on through all of these things and resisted the temptation to think that they knew how to time the market. And if it's one thing I hope your listeners take from this is do the right thing, buy index funds, be diversified, have a portfolio allocation that's appropriate to your age and risk level, and please don't let your emotions get to you, because if in fact you do and try to make changes, you're going to harm yourself. You're not going to make things better. You will do yourself irreparable harm.
Well, it sounds like you're wrapping up, but if I could just maybe ask a few more questions about AI, and I'm going to propose two reasons why it might be different, and then you're going to tell me, no, don't worry about it. The one is the rate of change is going to be so much faster. The acceleration of the power of AI might outpace, let's say, the acceleration of, say, the changes brought on by the internet. And the second thing is with the, let's say, some of the policies that you might not agree with. You mentioned that immigration, and now it's going to be so much harder for foreign students and for people in the sciences and computer science. It's becoming less and less attractive for somebody from other countries to come to the United States. And you read, oh my goodness, I went to this factory in China. They don't even have lights because it's all machines, it's all AI driven. They're just going to be so far ahead of us. Does that kind of thing worry you, that we're actually going to not be the major superpower that we are today, and that could potentially bring down prices? Um,
Well, I think that history shows that in general, the adoption and the way that these major innovations have affected the economy have always devolved just in a slower, not faster fashion. So I would, question the premise in your question that this is going to be very much faster. But suppose it is. Suppose it is faster. I think if we retain the freedom that we have, I am not going to worry about China outdoing us. If anything, I'm worried about too much investment in AI. I still would bet on our system of government and the United States versus China. And I would say one other thing in terms of, this is going to bring down prices. And we're not going to have jobs for people. One other major change, and this is where it is possible to make better predictions, and that's in demography. We are a nation that is aging very, very rapidly. There are many more people like me in my age group than there were 10 years ago and 20 years ago. and the fertility rates in the United States have now plummeted to an all-time low, and the fertility rates around the world have plummeted. The only place in the world where fertility rates are high are in Africa. So, if anything, the needs that we will have for personal service, the caring for elderly people, that is unlikely to be able to be done with robots, is, I think, they'll be different, no question about it. But it's not going to be this upheaval in the economy that everything is done with AI and robots. There will be so much more need for personal service and for cooking meals and doing things like that, that it'll be different. And that's fine. We want an economy where things are different over time. But will it upend the economy? I don't think so.
Well, Bert, this has just been so valuable. And speaking for myself, I'm not surprised that you were a big advocate of hanging in there, staying in common stocks, having a well-diversified portfolio of stocks. But the other thing that you've given me is, frankly, greater hope for the future. So if you've done that for the audience, that's even better. So I want to thank you so much. By the way, we're on slide 14 of 83 that I had prepared. So you've been very articulate about so many things. Is there anything that I didn't get to that you want to tell I think we have close to 400 people on, and hopefully I'm going to try to get this information out there, not only to the people listening today, because I've actually seen on the chat some people who want this information, but to people who haven't heard it. Is there anything else that you'd like to say to wrap up for our audience today? And then after you do that, then maybe Eric will tell us about the rest of the day, and then I'll have a few closing words.
Well, let me wrap it up this way, that you had indicated that you were happy to have me on because I played a role in the acceptance of index funds, and was instrumental in making the idea of reasonably efficient markets accessible to people. And, I am certainly proud of that. But let me tell you the thing that I'm kind of most proud of in terms of a career in finance. And that is the kind of countless letters and emails that I have received from people. And, I still get one or two of them a week. And the typical letter or email will be, I just want to thank you. I read one of the earlier editions of your book, and I have put my retirement funds wholly in diversified index funds. And I accepted your advice that when things got tough and the sky was falling and there seemed to be no hope for the future, I stayed the course. And I'm just so glad that I did, because, I never had much money in my life. but I put a little money into the retirement fund period after period. And I'm now enjoying a comfortable retirement, and I thank you for it. That's what really makes me happy. And if the people listening take nothing more out of this session, then that kind of advice, I will be delighted. And they follow your tax advice to also not only do the right thing about investing, but try to minimize their taxes in the best legal way possible. That'll be terrific. So I thank you for the opportunity, and you keep up the good work yourself.
All right. Thank you again.
Thank you.
Okay. I will mention that we do like index funds, or I didn't want to get into it with Bert because I know he was avoiding mentioning any particular funds, like Vanguard or anything else. We work with money managers who do believe in index funds, or let's call it enhanced index funds, like dimensional. And one of the, let's say, differences, and Bert, by the way, recognizes the value of saving money on taxes. He also recognizes the importance of safe withdrawal rate. He wasn't specific on, let's say, the difference of how you would invest your Roth IRA versus your traditional IRA. But that is, and even Jack Bogle himself, let's say, known for low fees, even he actually, and unsolicited, said that there is a place for an advisor. And let me just mention a few things about what we do that is a little different than, let's say, other financial advisors. So we do believe in passive investing, and we have selected money managers that do that. And they do all the things, or many of the things, that Bert did not mention, like asset location, getting the taxes right, having, planning for the, let's say, the legacy and the estate planning, which of course is what I like to do. And I'll go into this at length further, but I think we have pushed the envelope. I didn't realize he had gone so far. And again, we had a lot more questions prepared. But we actually think that the best combination is having a low cost index type investment along with the best tax strategies that you can get. And unfortunately, they're two different skill sets. Getting the taxes right, the tax loss harvesting right, particularly the Roth IRA that has so many opportunities, the asset location right, the estate planning right, that is a different skill set than actually managing money and doing asset allocation. And what is different about our method of doing business is that we actually have what I believe is the best of both. So you have a wonderful money manager using some of the passive type investment ideas that Burton was talking about, the whole time. And you get the benefit of our firm who run the numbers, do the tax projections, do the Roth IRA conversions, get involved with your estate planning. And rather than being charged twice, you actually pay one fee that is split between us and the money manager. So I actually genuinely believe that we have the best opportunity for value for the investor, because we're covering both the index or index like investments, and asset allocation, asset location, and all the work, that fine work and high value that they provide, along with the tax, estate, long-term planning that we provide. And if this is of interest to you, you might want to, and Erica and Justin, you might want to put up the opportunity or the way people could request a consultation with us. And we take consultations very seriously. I personally look at each one. I actually, if I think that we are a good fit to do business, and the biggest criteria is, can we really help you? If you have everything right, which doesn't happen very often, or you're in a situation where I don't see the value that we can provide, then I will not even go the next step. So what you do, I guess what I'm saying is, you don't have to worry that we're going to have a consultation. I'm going to quote, sell you and then not provide value. I'm at the agent stage and we are so busy as a firm. We don't need clients that we can't provide value to. We only want to take clients that we can provide enormous value to. And if you are interested in exploring that opportunity to talk with us, see if you agree that we are a good fit to do business. I'm gonna, and I don't see the same screen that you do, but I'm gonna ask Justin to put in a place where somebody could sign up. And then we will request a bunch of information for you, maybe more information than you want to spend the time preparing. The reason for that is I want that consultation to be really valuable, whether we do business or not. Again, I've done thousands of consultations over the years, and obviously I haven't done business with everybody, but no one, to my knowledge, has ever, including in the old days when people used to fly in from all over the country or go to great lengths to go to those consultations. And I still have people driving a long ways for our live presentations. No one has ever said or even hinted that they didn't get value from that consultation. So if you are interested in work and, let's say, maximizing tax opportunities, let's say minimizing taxes, getting the Roth right, and we're not soliciting legal work, but we can help you find the appropriate attorney, and then I can at least take a look at what you do have, and I'll tell you, I'm usually not very happy with what people have. I'll look you straight in the digital eye and tell you, I don't think that there is a better deal than the combination of us doing the tax and conceptual and estate planning work and a great low-cost enhanced index investment firm doing the kind of work that they do. And if you are interested in moving forward with that, I would encourage you to fill out we're just starting with a name and a telephone number or email, and then our office will take the next steps. Anyway, I look forward to a great rest of the day. Erica, the next one is that at 1 o'clock? She'll tell me if I'm wrong.
Yes.
But it's at 1 o'clock, and it's something that Burton didn't talk about at all, but it's actually critical to your lifestyle and your enjoyment, which is how much money you can safely spend. And I think that that's really important. We have new information, and not only new information from on, let's say, the classic 4% to 4.7%, but a lot of new information about different time horizons. It's really, I've never made this presentation before. I'm very excited about it. I think it will provide enormous opportunity. And it's one of those things that the right type of advisor, and hardly any advisors are talking about this other than, let's say, at the old 4% rate. And we're going to be talking about more than 4%. And we're also going to talk about different time horizons. So do tune in at 1 o'clock. And so, Justin, I guess if you can have two things up, one for a consultation, one for the remaining two sessions, the third one being for Roth IRA conversions. And I hope to see everybody at 1 o'clock. So thank you very much. I apologize for not having a break. I'll take responsibility for that. The time flew. I didn't realize that we were that far along, but there will be a break for the next one where we have more control. Thank you again.